Well, good morning, everyone. Thanks for joining us today. We're so glad you are here with us today. My name is Tara. I'm here with Bill Witt, and we are part of Senior Resource Center. And this is part of our live webinar series for SRC University. And today's topic is tapping home equity. So we'll be talking a little bit, and then we're going to be joined by Brian McRae. He has created a wonderful video to kind of explain the benefits of using a reverse mortgage to help in long-term care or in retirement in general. So we are part of Senior Resource Center University, or SRC University. We created this to give retirement education to the community and make it in short sessions available on your schedule. You know, we wanted to make sure that people have information on topics that, you don't hear a lot about or you hear too much about, and we want to make it simple for you. Many of these topics are in our book, so if you're interested in our book, you can always download a free PDF from our website, or you can just pay $5 shipping and we will send you a free softback book. And our ultimate goal is to create a safe, secure retirement. And at our school, we don't have a final exam. All right, so just to kind of recap, we've been doing these live webinars since late summer, and these are some of our topics we've already covered. And if you're interested, you can always go back and join SRC University, and you'll have access to all of these webinars for free. You're welcome to listen to them, pass them on to friends and family, and listen to them at your own time. And today we'll be talking about tapping home equity. And then next week, we will be discussing protecting your wishes and the right legal documents you need for while you're alive and then when you've passed. All right, so at SRC University, we do 4 distinct things. So we are not just a one-stop shop. We do comprehensive retirement planning, looking at people's whole profile and looking out 20 and 30 years to make sure they're not going to outlive their money. We do tax planning, and what we mean by that is helping people find ways to pay less tax. We do a lot of long-term care planning, and that includes federal and state programs like Medicaid and VA, and making sure we can protect and preserve assets and still get long-term care. And then estate planning and making sure that people have their legal house in order. So with that, I'm going to pass it on to Bill to talk about tapping your home equity.
Hey, good morning, everybody. Hope you all had a great Thanksgiving weekend. Nice to have some time off, and Thanksgiving's a good time to do it. Today, we want to talk about a topic that is proved very important to many of our clients. As we move into retirement, we usually have 2 major assets. We have qualified funds, IRA, 401k, or Roth funds that we've saved up while we're working. And for most of us, we also have a home, and the home often constitutes a significant portion of our net worth. So today's topic is talking about how do we take advantage of the equity in our home, and there's multiple ways to do that. So what's the underlying problem? Well, human longevity continues to increase. And the number one question I think we've tried to answer for all of our clients in building a retirement plan is how to help people avoid outliving their savings. None of us wants to get to be 80 or 85 or 90 and living on just Social Security. That doesn't feel too good. So having a plan could be an active plan or a potential future plan to tap home equity may be an important part of creating a safe, secure retirement. So today's topics: the impact of longevity, 3 strategies to tap home equity, and then we'll deal with your questions. So let's talk about the impact of longevity. If you have a few minutes free, you can do what I did years ago, which is to Google, what was the life expectancy in the Stone Age or in Roman times, in medieval times, all the way up to about 1900. And what you'll find is the number is always right around 30 years. I'm showing 32, but it kind of bounces around. But the average longevity for humanity for most of its existence was about 30 years. Well, Google then what is the average life expectancy in 2024? If you're born today in the United States, your average life expectancy is projected at 78 years. That's a pretty big increase. But even that increase doesn't tell the full story. And if you do further research, what you'll find out is if you're 65 today, that men on average have an average life of expectancy of 18 more years, or out to age 83. If you're a woman, it's 20 years. But once again, these are averages. And, if you watch your health and watch what you eat and, get regular medical care, half of us are going to live well beyond these numbers, which means we'll live into our late 80s, 90s, and some of us will make it to 100. And so with that, we have to find ways to support lifestyle going into the future. So in past webinars, we've talked about ways to multiply or create more money from retirement accounts. And so you can go back and listen to some of the webinars we've done on how we use products that generate income. We use a part of your 401k or IRA and create a lifetime stream of payments that, if you're married, covers both spouses and pays out until someone goes to heaven. When you go to heaven, if there's still money left in the bucket, that goes to your heirs, your kids. But for many people that draw income like that for over 10 or 12 years, they drain the bucket, but it's a lifetime payment. It's something you can't outlive, kind of like, just like Social Security. For most of us, after we've drawn Social Security for 10 years, guess what? You're getting free money. The government's paid you back everything you put in and your employer, but the checks keep coming, and that's a pretty good feeling. So today we're going to talk about tapping home equity, and there's three strategies. One is downsizing. The second is using it to generate rental income. And the third one is tax-free home equity, finding a way to take money out tax-free out of your home. So what about downsizing? Well, if you live in the Austin area, I live out in Burnet, but even out there, housing prices continued to soar over the last 4 or 5 years. And today they're near or at all-time record highs, which means the equity in our home is grown into a very substantial portion of our retirement funds. If you were to sell your home, here's some good news. Years ago, they changed the rules. It used to be you had to, if you wanted to sell a home after you'd lived in it for a number of years, you had to take the amount you'd grown in value and roll it into another home. But that's not true anymore. Today, if you buy a home, live in it for 2 of the previous 5 years, and then sell it, you have a choice. You can reinvest it in another home, or you can claim it and use the funds that you've taken out for whatever purpose you want. And here's the good news. If you're single, you get a $250,000 step up in basis or step up in original value. So an example, if I was single, if I bought a home and I paid $300 for it, and 5 years later I were to sell it, and the home had increased in $250,000 in value, I wouldn't have to pay any tax on all of that gain. I'd get to keep not only the $300 I put in originally, but the $250 of additional value. If you're married, the number's even bigger. It's up to $500,000. So you buy a home for $500 and sell it 7, 8, 10 years later for $1 million, and you don't have to give Uncle Sam a single penny. That's pretty sweet. And so for some people, as they get older and go, gee, I don't want to spend time maintaining a home, keeping up a yard. I'd rather move to a senior friendly community, maybe a independent living senior community. You could sell your home and then take the proceeds, and that could help fund and support a very nice lifestyle as you age in wherever you're living. To get this benefit, you have to live in the home for 2 of the previous 5 years. So downsizing is door number 1. This is kind of a 3-door strategy like the old TV show. Door number 1, downsize, take the value and use it to support lifestyle. If you do this, we can show you how to use some of the proceeds from the sale of your home, once again, to generate lifetime income, because we're very income oriented in our practice. The second option is one that some people are now exploring, and that's using a home or part of your home to generate rental income. I live out in Burnett, and when we first moved out there, we had 3 kids in college, and we ended up building a carriage house, a large garage where we had a nice living space above the house. We didn't live in the garage, we lived above it. And then after a number of years, the kids got out of college, and we finally built our senior-friendly single-story home that's right next to the carriage house. And our plan in retirement is to rent out that upstairs carriage house and generate some lifetime monthly income. And that's another way of being able to tap home equity. You put your home to use for you. And there are a variety of ways to rent out. You could do a traditional rental where you rent the entire building, or you can do part-time options. And you're probably familiar with Airbnb, Vrbo, Vacasa. These are organizations that help list properties that can be then rented and sold. And guess what? You have income coming in on a regular basis. Several of my neighbors are doing Airbnb, and they're renting out either part of the house or all of the house on a weekend and generating some nice income from it. So door number 2 is rental income, something to consider. Another way to think about this, if you have kids, oftentimes in the families we're working with, we find that some of the kids that moved out 10, 15 years ago are now doing what? They're moving back home. Well, if that's the case, think about it. You give your son or daughter back the bedroom they had, and then it's time to ask them, hey, you need to participate in helping maintain the household. And so you negotiate some type of rent, so you're getting some income coming in to support your lifestyle in retirement. And this is a nice one because you get to stay in your home and benefit from renting it out. The third one is one we're going to talk about in length, and actually we're going to invite in through a video link Brian McCray. Years ago, they created reverse mortgages, and I'm going to let Brian explain it, but it's a way of tapping the home equity in your home. You stay in your home, you own your home, but it's a way of tapping home equity. And so for people that go, gee, I don't have quite enough in retirement savings to support my lifestyle, but I want to stay in my home. I want to enjoy it, live there, but have enough money to put food on the table, to pay the property taxes and keep moving forward. We found that a reverse mortgage could be one option. And what I like to tell everybody, within our practice, we have a number of financial products. And each one of those is a tool, and not every tool fits every one's situation. But if you're house rich and otherwise savings poor, a modern reverse mortgage is something that you may want to consider. Within our practice, we have probably 15 or 20 affiliates. These are organizations that we've worked with over the years, and they provide additional expertise and support for our clients. And so we want to take advantage of that and be able to show people how to take advantage of it. And I'm just noticing up here, there's supposed to be a little link on there that gave us a link to Brian's video. So hold for just a second, and we're going to see where that went. And I guess here it is.
Okay, let me see. I will get it up here.
My name is Brian McCray. I'm a retirement mortgage specialist with Fairway Independent Mortgage. I work exclusively with those over 62 to help them reposition home equity and live their best retirement. So today we're going to talk about reverse mortgages in general, kind of some of the general terms, general overview, but also about some of the specific points of the home equity conversion mortgage. And the idea is to give you enough information to see if this might be a program that could possibly be a fit for you. Now, first of all, this program was designed for those who are looking to age in place and looking to put a safe and intentional portion of their home equity to work in retirement. So the minimum age is 62. So we're looking for those who are near or in retirement. And if you're concerned about things like market volatility or in today's world, inflation is a very real concern. Longevity risk is something that we're all concerned about because we're all living longer lives. And so outliving your savings can be a big concern. And you might be among the 40% of retirees who is still making a mortgage payment, which means you're sending money to the mortgage company despite the fact that you're on a fixed income. And finally, you might be concerned about the suitability of your home. Is it practically efficient, practically effective to age in place safely? What exactly is a reverse mortgage? Most importantly, it's just a mortgage. And so a lot of the fear and uncertainty and doubt and myths about the reverse mortgage can really be allayed by understanding that this is just a type of mortgage. A mortgage is a lien against your home that requires a specific debt to be repaid, and the reverse mortgage is no different. Now, there are a couple of rules. It functions differently than a traditional mortgage, but by and large, it works just like any other mortgage does. So the specifics, remember, this was designed for those who are looking to age in place. And so you have to be 62. It's designed for those who are in or near retirement. And the fundamental idea is that the home equity conversion mortgage converts a safe and intentional portion of your overall home equity, typically between 40 to 60% of the overall value of the home, and converts that into a tax-free line of credit that you can use for just about anything. Now, if you're using it to replace your traditional mortgage, we would use the line of credit to pay off that mortgage. Now, the home equity conversion mortgage does not require a monthly principal and interest payment. And so one of the biggest financial advantages can be replacing your traditional mortgage, where you're making hundreds, if not thousands of dollars in payments every month, with a home equity conversion mortgage, where the principal and interest components of those now go away. Now, you still have to pay all of your property charges. So you got to pay your property taxes, you have to pay your homeowner's insurance, have to pay your HOA fees and any other associated property charges. But the principal and interest component of that payment goes away. Generally speaking, as soon as I say the words reverse mortgage, you're probably thinking, isn't that the loan where the bank gets your home in the end? And that's what everybody thinks. It's one of the most pervasive myths about reverse mortgages, and in my opinion, one of the most damaging, because it keeps us from considering this very valuable vehicle. Because the truth is, you own the home. Just like any other mortgage, it's just a loan. It's just a lien against the home that the loan has to be satisfied at the end. But you, the owner, or the heirs, or the estate, are entitled to the equity. You're still in the deed. You still own the home. You can still sell, refinance, just as you would with any other mortgage. The HECM is a type of reverse mortgage. This instrument was constructed from the ground up in 1989 to allow those over age 62 to access a safe and intentional portion of their home equity to help them get through retirement. It is the most widely used reverse mortgage program in the United States. Fortunately for you, the consumer, the home equity conversion mortgage is likely the only reverse mortgage program that you'll be able to use. Now, there are a couple of lenders who offer proprietary reverse mortgage programs, but they are generally for higher dollar value properties. By and large, most of the reverse mortgages out there are the home equity conversion mortgage. Now, this loan is guaranteed by the federal government. It's an FHA loan. And as I mentioned, it was designed for those who are looking to age in place, looking to use a portion of their equity to help them get through retirement. And for that being said, the minimum age is 62. Leads to another one of the biggest myths about reverse mortgages, and that's my estate or my heirs are going to be left with a big bill at the end. And that's also not true. Two reasons for that. Number one, because we're only offering up between 30 to 60% of the home's overall value at the time of the loan. It's extremely rare for you to be able to consume all of your home equity over the life of that loan. However, if you are one of the outliers and at the very end, the home's value is not enough to cover the amount that's owed, well, that outcome is protected. It's actually insured, part of the guarantees of this program. And what I mean by that is this is a loan of no recourse. And this means only the home can be used to stand for this loan. And so if you get to the end and the home's value is not enough to cover the loan balance, insurance steps in and covers that gap. There's no recourse against the borrowers or their heirs if the home's value, for whatever reason, should come up short. So contrary to popular belief, the modern reverse mortgage is one of the most highly regulated loan programs out there and offers numerous protections to the consumer, like this no recourse feature. Here are some other examples of how highly regulated the home equity conversion mortgage is, along with some of the specific regulations. First of all, and this is among my personal favorites, is that borrowers have to receive counseling during the loan application process. And this counselor has to be an independent third party. This counselor's job is to make sure that the borrowers understand both the reverse mortgage in general, but also the specifics of their loan in particular. And so it's another set of eyes that's not attached to the loan. And the counselor is an uninvested third party. Their job is to make sure that the borrower understands both the basics of the reverse mortgage and the particulars of their loan. In addition to only offering up between 30 to 60% of the home's value in total, there are also some initial disbursement limits. In the first year, you can only take up to 60% of the available balance. And my favorite feature of the home equity conversion mortgage is this line of credit. There is a significant growth feature attached to it that will help you grow liquidity from your home equity. This has been the subject of numerous videos, and I won't spend a whole lot of time on it here in this overview course, but the line of credit growth on a paid off home can be a significant way to build real liquidity over time. And this can be one of the most valuable financial planning points for your financial advisor, because they may not be considering the home's value actively in their retirement portfolio right now. This leads to our next myth: aren't reverse mortgages a loan of last resort? And the answer is a resounding no. They used to be. They used to be considered a loan of last resort, as something that you would do if you were in dire straits financially. And there is, I think, a social reluctance to the idea of even using home equity. My parents and my grandparents were trained to pay off their homes. And by and large, the last two generations of people have stored a massive amount of wealth in home equity. And it largely sits idle during retirement. And so, contrary to popular belief, the modern reverse mortgage, the home equity conversion mortgage, was designed from the ground up to allow those over age 62 to access a safe and intentional portion of their home equity. Now, if you're among those who have a significant amount of home equity, if you've got, say, more than 50% equity in your house, I would imagine that this represents one of, if not the largest source of wealth in your portfolio. And yet, odds are you're probably not using it. And in the aggregate, those over age 62 have amassed more than $13 trillion in home equity. And it largely sits idle during retirement. And that is the fundamental purpose of the home equity conversion mortgage. So let's talk about who qualifies. This is a very specific program, and it is designed for those who are in or nearing retirement. And so the youngest you could be is 62 years old. And only your primary residence is eligible, so no vacation homes or second homes, because you do have to occupy the house. And you need to have at least, say, 50 to 60% equity in the home for the numbers to make sense. Otherwise, you're bringing a significant amount of money to closing, and the numbers typically don't bear themselves out. Finally, this is not a program that's designed for short-term use. So if this is a home you're only going to be in for the next 18 to 24 months, there might be better ways to access the equity. The home equity conversion mortgage is more designed as an age-in-place vehicle. The economics really bear themselves out the longer you stay in the home. When you're working hand in hand with a financial advisor with the home equity conversion mortgage, the financial advisor has a number of different strategies that they can use to integrate these funds. They might use the home equity conversion mortgage and the proceeds to help keep your income low, because the line of credit is tax-free. So it's not counted as income, it's counted as debt. And that might help your traditional retirement funds last a little bit longer, helping mitigate that longevity risk, because as I mentioned earlier, we're all living longer lives. And then finally, and this is something that the majority of my clients are dealing with, is long-term care. 70% of us are going to need long-term care at some point. And it's been my experience that those who need long-term care will wind up using their home equity in some form or fashion. And so putting this in place early as a hedge against long-term care, and then also having this line of credit available when it's time for the long-term care expense can go a long way towards helping you be prepared for that event. There's a significant body of research around exactly how best to integrate the home equity conversion mortgage into the retirement plan. And it's led by Dr. Wade Pfau. Dr. Wade Pfau is a professor at the American College of Financial Services, and he actually ran the Retirement Income Certified Professional Program. RICPs work on the retirement side of retirement, helping you draw down your retirement portfolio in the most effective fashion possible. And so Dr. Pfau has a very specific strategy for integrating the reverse mortgage into any retirement portfolio. So if you're in or near retirement and you are looking for ways to protect against longevity risk, to mitigate potential long-term care expenses, the fundamental idea here is to position your home equity. Because if you're among those who have that portion of $13 trillion of home equity, odds are it's not being used right now. And so the home equity conversion mortgage is the instrument that allows you to position a safe and healthy portion of that home equity to take full advantage of it within the context of your retirement portfolio. Reverse mortgages aren't for everyone, but in the right circumstance, they can be an extraordinarily powerful financial tool to help you thrive in retirement. I hope today's video helps you understand reverse mortgages and also the home equity conversion mortgage at a little bit more of a higher level. And ideally, these concepts will help you make a really informed decision about whether or not the home equity conversion mortgage might be a good fit for you.
All right, that was wonderful. So I hope you got some good information out of that. I know that we have been working with Brian, yep, and Fairway for quite a few years, and they do really have a great program. And he really does sit with our clients and basically hold their hand through the whole experience. So we really have enjoyed, working with him and partnering with him. So whether you use just, a bedroom in your house to get some rent or consider using a reverse mortgage, we just want to inform people of the benefits of tapping your home equity to get additional income, whether it's for retirement or to pay for long-term care.
Wow, we covered a lot today, Tara. Do we have any questions?
I don't think so, but if you have any questions or have a specific situation that you'd like to discuss with us, you're always welcome to give us a call, send an email. You could call Brian directly or, schedule an appointment with us. And we'll have this presentation posted in the next 48 hours on our website. So if you have someone you want to pass it along to, we'll have it up for you then.
Super. Well, thanks everybody for joining us today, and look forward to seeing you next week with another topic that's relevant to creating a safe, secure retirement.
Oh, we do have a question.
Oh, we do? Good.
Oh, what are the costs? Oh, I missed it. Let me see again.
This is what are the costs associated with reverse mortgage?
Oh, what are the costs associated with a reverse mortgage? I think they're specific to the reverse mortgage. It depends on what type you get.
Yeah, and I think that's more of a Brian McCray.
Yeah.
We, while Brian's an affiliate of ours, we're not associated with or compensated. If he sets up a reverse mortgage for a client, that's between you and Brian. I think it'd be worthwhile calling him if you have questions on this to know how much it costs to set it up. And I kind of liked his idea that this is not something you have to, you don't have to wait until you're in a dire strait to set this up. It's something actually you could set up earlier in retirement and have essentially a credit line available to you that as you want to tap it, you can tap it. Let's say you've got other investments in the stock market and the market takes a slump, goes down. Well, this is a way of being able to tap equity and not have to tap the value you've got that's in the stock market if it's in a down situation. So I think those questions should be directed to Brian because he's the expert on reverse mortgages. So with that, I appreciate everybody joining us, and please join us next Tuesday for another episode of SRC University.
All right. Have a great week. Bye-bye.
That's